Okay, so from here we need to continue now,
Yeah.
right?
Yeah.
Valuation using the three-stage dividend discount model. Three stages. Okay, just you tried this question or not?
No, no.
No? Okay, so we'll do this now. Let's go through it. Current dividend of 1, required return 12%, dividend growth rate 15%, projected for the next 3 years, 2 years, followed by 10% growth, and then next 4 years before settling down to the constant growth of 4%. So 3 times the growth rate is changing, 15, 10, and then 4%. So currently it is $1. So $1 and 2 times it is growing at the rate of 15%. So 1 plus 15% will be 1.15, right? Check.
Yes.
This one 1.15 into 1 plus 15%.
Yes, sir. It's 1.15. And then into 1.5.
Yeah.
1.33225.
Then next it is growing at the rate of 10%, 10% for the next 4 years.
Yeah.
So next 4 years 10%.
Then 1.45.
How much?
1.45.
1.45.
Then 1.6.
Yeah. 1.45, then 1.6.
Then
Just go for
1.76.
3-4 decimal, because then otherwise some deviations will happen.
760. And 1.455.
This one 1.455.
55. And 76. 6. Wait. 1.455. 1.600.
Then 1 to 4 times, no? This
Huh.
one
1.7605.
so 1 2 3 fourth time again.
1.9366.
1.9366.
Yes.
Then after that it is growing at 4% constant.
Yeah.
4%.
2.014.
Okay. Yeah.
This we will do this now
Gordon growth
4%. Yeah. So Gordon growth. So divided
divided
by
by R is
12.
12%,
8 divided by 8.
minus 4%. Just solve this.
Yeah. It's 0.2517.
How much?
Sorry. 25.17.
25.175.
175. Yeah.
So this is the cash flow. Okay. So the required rate is 12%. So this one 12% raised to, this is 3 4 5 6. So raised to 6. I will do this one will be 1 plus 12% raised to 5. Then this is 1 plus 12% raised to, so this one is also there, 1 plus 12% raised to 4. Then this is raised to 3. 1 plus 12% raised to 2. 1 plus 12% raised to 1.
Sir, can't we use CF function?
Yeah, cash flow function you can
Yeah.
use. Okay. So so you can do all this, or alternatively, go to
Yeah.
cash flow function, keep CF0 as 0, then CF1 as
1.15.
1.15, then CF2 as 1.3225, then CF3, CF4, CF5, and CF6 you have to add these two
Yeah.
numbers, and then interest you select 12 and
Yeah.
calculate net present value.
$18.8680.
Hmm. Okay, then we'll move to the next one. Three-stage model with linear growth decline in stage 2. Linear growth, okay, that is the key word here.
Okay.
So the moment you
Yeah.
say linear,
H model.
then H model. As you analyze, you have gathered the following information on your, as an analyst, you have gathered the information on your company that are tracking the current annual dividend. Okay. So the current annual dividend is 0.75. Dividends are expected to grow at the rate of 12% for the next 3 years and decline linearly to 4%. Okay, linearly, that is the keyword here, over the next 6 years. Okay. So first of all, current dividend 0.75 expected to grow at 12% over the next 3 years. 1, 2, 3. 0.75. 12% over the next 3 years. How much? Calculate.
0.84.
Next.
10.94. 9408. 0.9408.
Hmm.
1.0536.
1.0536.
Yeah. So 12% for 3 years and then decline to 4 over next 6 years.
Declined to 4% over the next 6 years. Declined to 4% over the next 6 years. Okay. Declined to dividends are expected to grow at a rate of 12% over the next 3 years. Decline linearly to 4% over the next 6 years. Okay. 6 years.
Sir, they are not doing this in
H
the book.
model.
Yeah.
Yeah, and then remain at a equilibrium of 4% in perpetuity. So from here on, 4%. Okay, now see till here,
Uh,
from here on, H model begins.
yeah.
Okay, not before that.
Yeah.
Okay, so from here on, H model is there. So let's calculate this one now. H model perspective. First, I'll take this one. So this is D1. Actually, I need to calculate now what is D1. Okay. They have taken 0.53 0537 0537 will take. Okay, 0.0537. Yeah.
It's one point
So
zero five three.
so this is you. We consider this as the current dividend.
Yeah.
Okay. So H model says D 0. This is
Yeah.
the formula. Na? First one is D0 into 1 plus
One
growth
plus
divided
long
by
growth.
R minus G.
Uh,
I mean, uh, loose formula if I
yeah.
loosely if I write.
Yeah.
This is like Gordon growth.
Yeah.
Okay. Uh, then
D plus H into G S
yeah,
minus
this is
G
like
H.
long-term growth,
Yeah.
and then D0 into half.
Yeah.
Okay. Then short-term growth minus long-term growth
Yeah.
divided by R minus
R
long-term
minus
growth.
long.
Okay. This is the formula, right?
Yeah.
Okay. So D0 is 0.537 into 1 plus growth. Growth rate is what? Growth
12%.
rate is short
12%.
term, long term growth. This
Yeah.
is long term growth.
Okay.
So long term growth is 4%
4%.
divided by the required return is 9% minus
4.
long term growth is 4% plus 0.537 into 1 plus, not 1 plus,
Sir, it's 1.0537.
is not 0. Point,
No, no, it's 1.0537. There also it's 1, but you've made that red line on that one.
oh, this is
Yeah, yeah.
1.0537. Okay. 1.0537. So this is also 1.0537. Then half of how many years? 6 years. So 6 by 2. Okay. Into short term growth is
12.
12 to 4 percentage. 12 percentage minus 4 percentage divided by R is 9 percentage minus 4 percentage. Just solve all this.
Yeah. 26.97.
26.97.
Yeah. It's
Overall,
a
26.97.
26.97.
Okay. Then this part I need to solve now. This part is normal as usual. We will solve it. Okay. 1 plus required rate is 9. If you want to use cash flow, you may use.
Yeah. $23.1648.
Okay.
Yeah.
So now you add these two together. How much here you got? Here you got
20, uh,
26.
0.94. There I got 23.1648.
It's not matching. 26.97 is okay.
And 23.16. It's matching, sir.
No, price of the stock, it is supposed to be added and shown. No? This is okay. Now we have a series of cash flows. We discount, okay. 0, 1, 2, 3. They are shown separately. No. Acha, you have added already.
Yeah.
Acha, you have added and you have discounted this value also, right?
Yeah.
Acha, this, okay. You have discounted it by 3 years. 9% raised to 3. Right. Okay. Yeah, it's fine. Okay. Calculating expected return with a Gordon growth model. Okay. Smith and Wesson explosive stock is expected to pay a dividend of 1.60, has a current price of 40 and has a projected growth rate of 9. Calculate implied rate of return. Implied rate of return. Current price is 40. Expected to pay 1.60. D1. R minus G. R is projected growth rate is 9. So R minus 9%. So solve this.
Yes. Yes.
Done.
No, sir. Is that 4% or it's 9%?
9.
That's 9%.
What happened? You need help?
No, I did it by 4%. So I'm redoing it again.
Okay.
Yeah, certain.
Okay. The next one, H model can be rewritten in this format, but we don't have to follow that format as such. Why to unnecessarily remember another formula? We can
Okay.
use the existing one only, and we can do some algebra uh, and we can find out. Okay.
Yeah.
So there is no need to remember this formula. Let's try this here. See, Beluga Fisheries Inc. just paid a current dividend of $0.75, which has been growing at a rate of 10%. The growth rate is expected to decline to 5% over the next 5 years and then remain at 5% indefinitely. Calculate the implied required rate of return for Beluga based on the current price of $30.
Okay.
Okay. Calculate the implied required return for Beluga. So it is declined over the next 5 years. So this tells us It is H model, right?
Yeah.
Okay, so H model is equal to, under H model, P0 is equal to D0 into 1 plus G divided by R minus long-term growth plus D0 into half uh, short-term growth minus long-term growth. Okay, so now D0 0.75, 1 plus, this
5.
is long-term growth, 5% divided by current price is 30. Okay, R we have to find out.
Yeah. No, R we have
Implied
10%.
rate of return on the current price. No, which has been growing at the rate of
Okay, that's not R.
solving for
Okay.
expected return with H model. R we
Okay,
have to
okay, okay.
find out. Plus 0.75. Half means here
5 years.
expected to decline over the next 5 years, 5 by 2. Short term growth is decline and then remain at 5. So 10 to 5 percentage. Here it is 10 divided by R minus 5. So you just have to solve this. You
Yeah.
can take this, solve this numerator, then solve this numerator. You can take the LCM. So both will come common. That means
Okay.
okay, it will come like this. Now add up all this same number. It will, these two. Then it will become easier.
Yeah.
Do
So I got 30 is equals to 0.7875 upon R1 minus 5 plus 9.375 upon R minus 5.
yeah. How much you said? Say it again.
0.7875 upon R minus 5 plus 9.375 upon R minus 5.
No, numerator have you added both? You take the LCM.
Okay, I have to add both of the numerators.
Ah,
So by adding both of the numerator, I got 10.1625.
hmm. Further solve it.
No, sir, I'm not getting it right.
Okay. Just solve this part. How much are you getting? 0.75 into 1 plus 10.
0.7875. 7875.
Here, this part, how much have you got?
9.375. Okay. Then adding both of them, I got 10.1625.
10.1625.
Yeah.
Hmm. How much is this coming to?
Okay. 0.338375. Sir, I'll just bring my charger into use.
Hmm.
Hello.
Hmm, 7.94. It's matching.
Was there a calculation
This
error?
it is 0.09375. It okay?
Yeah, I'll just.
Hmm.
Yeah, okay.
So without that new formula, you can do this with H model original formula
Yeah,
itself. Okay.
yeah.
Solving for expected return with the two-stage DDM. Solving for expected return with the two-stage dividend discount model. Okay. Just go through this.
Yeah.
So again here, instead of current price, we have to calculate R.
Yeah.
So Ozone Laboratories Inc. recently paid a dividend of 1. Dividends are
Hmm.
expected to grow at 11% for the next 2 years and 8% thereafter. The implied rate. Okay. Can you do this on your own?
Yeah, I'll try, sir.
Huh. You will get the cash flows. Then you can use uh,
CF function.
CF function.
How can we use
Your
CF
CF
function?
function you cannot use here because R. No, you can find out IRR. Okay, so here you keep the present value as 30.35.60 minus and key in other numbers and find out IRR. Okay.
Sir, what do I have to do with 35.60? I have to keep it in CF0, na?
Yes, minus.
Yeah. Sir, I'm getting it minus 5.96.
How the required return can be minus?
Mm-hmm.
Okay, what is this value?
Okay. Wait, sir. Wait. I'll do it again, sir. Wait.
See, this is 8% thereafter means this is Gordon growth.
Yeah. Yeah. But for this also, we need R, na? For Gordon growth also.
Ha. Okay. Yeah. So what you can do is, okay. So in that case, that is the reason they have given these options here.
So
Okay.
we can do trial and error, basically.
Uh, okay. 1 second. Wait. Yeah. Trial and error you can do. This amount. This amount. This amount. Hmm. Yeah, you have to do trial and error. So trial and error means what you should do is begin with the middle number always. Middle means what? 9.5, 10, 11.2. Begin with 10.
Okay.
You will get the idea. Okay. Yeah, this is, they have mentioned it. Iterative process. Trial and error. See, they have mentioned here also. And then you can adjust.
No, sir, I'm not getting it. It's very confusing. Like I'm not. I'm getting 1.08 here.
Hello,
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 hello, sir. Can you hear me?
can you hear me?
Yes, sir. Hello, hello.
Hello. No, I'm not able to hear you.
Uh, my mic is on.
I
Uh,
can. Yeah,
okay.
I can hear you. You can hear, right?
Yeah, yeah, yeah. Sir, I was saying that I am not able to.
Yeah,
Hello.
yeah. You can see the screen, right?
Yeah.
How much is this number coming now? 1 into 1 plus 11 percentage.
1.11
And this number,
plus 8%, 11%, no?
1.11 into 1 plus 11 percentage.
1.2321.
It's 1.2321. And here,
1.330. 1.330.
okay.
So now R will be 10, like uh, if we do the trial and error method, so R can be 10.
1 second, hold on. Wait. 35.60. Okay, first let's say R is 10 percentage.
Okay.
So 1.330 divided by 10 percentage minus 8 percentage. Calculate this amount.
66.53.
Okay.
Yeah.
And then this two amount total.
I have to add both of those, na, in 66.5.
66.53 and
1, 1.
1.2321.
67.621.
67.
7621. 7621.
67.621, right?
7621.
67.7621.
Yeah.
and this is 1.11.
Yeah.
So again, you discount both with 10 percentage. You will have to do manually only, not cash flow function. This one. Or this much you can do using cash flow function. 35.60 equal to. You can check if it is matching or not.
Okay. I'll just first we'll do this manually then.
Yeah.
So the first one is 56.
This one,
Yeah, this one is 56.
point.
00173.
This one.
Yeah.
So that will not be right now then, because
What?
we don't have to calculate, because when we add up it will go beyond 56.
Yeah.
So that is wrong, 10 percentage. So we want to reduce the number because it has to come to 35. So it will reduce when the denominator is big. Denominator will be big
By
when we take
11.5.
11.2
11.2.
percentage. So now
Okay.
you redo again by taking 11.2 percentage. So it will be 1.330 divided by 11.2 percentage minus 8 percentage.
Okay. 41.56.
So it is 41.56 plus 1.2321. 1.2321.
42.7946.
42.7946.
46. So if we divide that by
1
1
plus
plus 10 percentage raised to 2.
y
Okay,
10,
yeah, sorry,
11.2
yeah, sorry.
percentage raised to 2. And here also 1.11 divided by 1 plus 11.2 percentage raised to 2. Raised to 1.
34.6.
Overall,
No. Okay, overall I'll
okay.
find it out. I'll find it out.
34.6. Okay. Then this one.
35.60 overall.
Which is matching, no?
Yeah.
Otherwise, if this we can do in cash flow function also, if you want to do CF0, you keep it as 35.60
60.
minus
Okay. CF1 will be
1 minute. Ah. So CF0 is 35.60 minus, and then
yeah.
CF1 is 1.11. CF2 will be 42.7946. You find out IRR, you will get 11.2.
Yeah.
Okay, fine. Okay.
Yeah.
sustainable growth rate. This also we have done in level 1. Remember, it was
Yeah, yeah.
growth is equal to growth
Retention
rate.
ratio into ROE.
Yeah. Growth rate is equal to R return on equity into retention ratio. Retention ratio. So return on equity is equal to net profit divided by average equity. Then retention ratio.
One minus dividend payout ratio.
Retention ratio is 1 minus dividend payout ratio. Dividend payout ratio is equal to
EPR, dividend
DPS,
upon
dividend per share
EPS.
by EPS. And yeah, so this is it. So now retention ratio is denoted as B.
Okay.
Okay.
Yeah.
So Biotechnica is growing earnings at an annual rate of 9%. It currently pays dividend of 20% of earnings. Biotechnica's return on equity is given. Calculate its sustainable growth rate. So return on equity is directly given. We have to calculate retention ratio. So retention ratio, they said annual earning is this much and dividend is this much. So that means
Retention ratio is 80%.
80 percentage. That's it. So 80 percentage. So growth is equal to 15 percentage into 80 percentage.
It's 0. Sorry, 12 percentage.
Is the growth. This is
DuPont analysis.
uh, yeah, this is DuPont analysis. Yeah, if the other factors remain constant, we can see that the growth of your firm's earnings and dividend is a function of its return on equity and growth rate. Yeah. Okay. So here, this return on equity,
Oh,
see, return on equity, uh, see, return on equity, I can use uh, dew point, correct? Dew
okay.
point. So growth is equal to return on equity into retention ratio. So return on equity, I can write using dew point. Okay, return on equity, I can write
Yeah.
using dew point. It was net profit margin into asset turnover ratio.
Into financial leverage.
Yeah, into financial leverage. Okay. And into retention ratio. I can say like this, right? Because all these are return on equity.
Yeah.
Okay. So net profit margin is net profit by sales. Asset turnover is sales by average assets. Leverage ratio is average assets divided by average equity. Okay,
Yeah.
retention ratio. Retention ratio is how much you are retaining. So the formula goes like this: net income minus dividend. Net income minus dividend. That means this is what you are
Yeah.
retaining based on
Divided by net
net
income.
income. Net income or net profit, you can say.
Yeah.
Net profit. Okay. So now when we yeah, so this is it. You can write like this. This is only they have mentioned net income by dividend by net income. This is retention part,
Yeah.
and this is all return on equity. Okay, which has been mentioned as Pratt model. Why Pratt
Hmm.
model is uh, okay. Pratt model. Pratt as in PRAT. So P stands for profit margin. Okay, R is this one.
Retention ratio.
AT.
Asset
See,
turnover. And
leverage they are addressing as T.
okay.
Okay, so Pratt model is this one. PRAT. Okay.
Yeah.
Now that you shuffle the way you want it. Okay.
Okay.
Now you want to try this sum.
Yeah, I'll do it.
Okay.
Got it, sir.
Yeah. This one. Okay.
Yeah, I'll do it.
Return on equity you want to try.
Yeah, I'll do
This is see here.
it.
See the problem that will come here is here. See, I have taken average.
Yeah.
Ideally, you should take average only.
Okay.
But here they said based on beginning balance sheet values. So you take only beginning balance sheet values, balance sheet perspective.
Okay.
Okay. That means opening value only, not the average value. Okay, try. Hmm. Done?
Yes, sir.
You're able to do?
Yeah, yeah, I did.
Okay, fine. The next one, you may just read this.
Yes, sir.
Huh. Yeah, this also you can do on your own. All these are easy only. Before this, all
Okay.
model quiz you have done, right?
Yeah, yeah.
These all are easy only.
So if I have any doubt, I'll ask.
Yeah. There is one module quiz which will be little tougher that I myself will tell
Okay.
you and we will do here only. Rest all whatever is very easy, I'm finding I'm not doing that because that you can do and then if you don't get then you can come back.
Okay.
Free cash flow valuation. We have already covered that table, right? That WAC firm. Acha. So now some more formula. Firm value. So we know free cash flow to the firm.
Yeah.
Okay. Okay. So through 4 ways we found out free
Yeah.
cash flow to the firm. So once I find out free cash flow to the firm, okay.
Yeah.
So free cash flow to the firm. Once you find out this is the free cash flow available. Now what is the firm's value then? So if this is the expected free cash flow,
Okay.
imagine at time 1, then it will be discounted with WAC. Okay,
Yeah.
discounted with WAC.
So this is how you find DCF, no?
You will get value of the firm. Value of the firm. Okay, this is the formula. You can write down this one.
Yeah.
The next equity value. So remember we calculated equity, free cash flow to equity as well, right? What is the formula? Free cash flow to the firm. Then from here we will minus interest, 1 minus tax. Then if we have borrowed more, it will be plus net borrowing. And if we have repaid the borrowing, then it will be minus net borrowing. Because if you are borrowed more, then the cash is coming in
Yeah.
which will be used by the equity holders. Okay. Then here CFO perspective,
CFA
um,
plus interest.
CFO perspective interest. No, not plus interest. It will be minus because in CFO already interest is deducted, which is what
Yeah,
we
yeah.
wanted. Fixed capital investments. Okay, then plus or minus net borrowing. That means again same plus net borrowing if we are borrowing more. Net borrowing. Okay.
Yeah.
Minus net borrowing if we are repaying.
Yeah.
Now this is the free cash flow to equity. Then what is value of equity? okay, or equity value is, discount it. If this is at time 1, then I
Yeah.
will use required rate, cost of equity. Okay, see, for if it is free cash flow to the firm, I will use WACC.
Okay.
Okay, why? Because it includes bond as well as equity, so I will use WACC.
Okay.
Here I will use cost of equity.
Okay.
Okay. Then another formula is equity value is equal to firm value minus market value of debt.
Okay.
Equity value equal to firm value minus market value of debt. Okay. You can just read this one. I'll connect the charger. Okay, so now this is another small concept. When your firm's capital structure is volatile, the adjusted present value approach can also be used.
Yeah.
What is that adjusted present value? The firm's unlevered cash flows. That means cash flows assuming no impact of leverage. That means no
Cash
debt
flows which are not going
are
for
discounted
interest, basically.
at the firm's unlevered cost of equity. Okay. NPV of debt, the value of the tax shield less uh, the cost of financial distress, is then added to the unleveraged firm. Okay. Are you able to understand this line? See, when a capital structure is volatile,
Okay.
volatile means what? You keep changing the capital structure
Okay.
again and again. So again and again changing the capital structure means you are increasing equity, or you are reducing equity, or increasing debt, you are reducing debt. So volatile
Yeah.
capital structure. So under that, if that is the situation, under adjusted present value, the firm's unlevered cash flows. That means cash flows assuming no impact of leverage. This is just,
Okay.
I have not seen any sums as such though. Cash flows assuming no impact of leverage are discounted at the firm's unlevered cost of equity. Okay. So cash flows being discounted. It is
Okay.
as good as free cash flow to equity. Okay. Free cash flow to equity being discounted. And then you are adding net present value of debt as well. Present value of debt you are adding, which is what? The value of the tax shield minus, so net present value of debt. Net present value of debt is equal to uh, value of the tax shield.
Yeah.
Okay. Value of the tax shield means the tax benefit that they are
Yeah.
saving because of debt.
The debt.
So value of tax shield. Tax shield means, are you able to understand?
Yeah. Yeah. Yes.
I think the net is very weak at this time. Value of tax shield less. Hello, can you hear me?
Yes. Yes, sir.
Hello.
Hello. Hello.
I think you are not able to hear me. Okay. Wait, I'll reconnect. Hello. Hello.
Hello.
Yeah. Are you able to understand when I say value of tax shield?
Sir, I'm not able to see the screen.
Oh, okay. Value of tax shield
Yeah.
minus uh, cost of financial distress.
Yes, sir.
So that is too weak. Not able to write. Just hold on 1 minute.
Yes.
Hello. Can you hear?
Yes.
Okay. So I'm not able to write. Let me just. I'm not able to easily write. Value of tax shield minus minus cost of financial distress. Cost of financial distress. Value of tax shield means what? Say for example, before tax cost of debt is 10 percentage
Yes.
and tax is 30 percentage.
Yeah.
So now they have to pay only 7 percentage. Okay, so that means
Okay.
remaining 3 percentage is the value that is getting created.
Okay.
Okay, so value of tax shield 3 percentage they are getting created. They are saving, but
So the
there will be some financial distress also for that
yeah.
reason.
Yeah.
That they will minus it. So that will be so so from that 3 percentage. Okay, let's say that 3 percentage is coming to 100 crores.
Okay.
So from that 100 crore, let's say 20 crore is financial distress. Then
Okay.
80 crores is the value of net present value of debt. And then this one unlevered cost of equity is free uh, cash flow to equity.
Okay.
Okay, fine. Okay. This is just a concept. I have not seen any sums, especially like adjusted present value
Okay.
like this. But it is okay to still, remember. Okay. Yeah. We'll stop now here, okay, because the net is getting weaker. Yeah. See, this one,
Oh.
uh, this is also okay. You can do. You can try this one as well
Okay.
at home. You just try this one. And even see, this is all we have done.
Yeah.
FCFF, this
Yeah.
formula. We have done this. And please read all this, okay? It will be very interesting.
Yeah.
Then this we have not done, but it's a straightforward
No, we
capital
have
fixed
done
capital
this.
expenditure is equal to expenditures done,
Yeah, we
capital
have done this.
expenditures
Yeah,
minus proceeds from sale of long-term assets.
yeah, we
So
have done
if you are
this.
spending 1,000 rupees for capital expenditure, but then let's say
We
you
are also
have got
selling
selling and
200.
ha,
Yeah, so
200
800
rupees
is capital.
capital
Yeah,
expenditure. Okay. Then there is one more. If no long-term assets were sold during the year, then in
huh,
that case, fixed capital investment is equal to ending PPE minus opening PPE net plus depreciation. So we will see this tomorrow then.
okay.
Tomorrow
Tomorrow,
morning.
sir, I'm not there.
Yeah, okay then. Okay, fine. So we'll connect again day after tomorrow or so, not a
Huh,
worry. Okay, so from here we will just continue. Okay,
okay,
from this, you also look at this, see if you are able to understand this. We'll continue, but anyways, from here. Okay,
okay.
we'll
Yeah,
stop now. Then. Okay,
yeah.
okay then. Bye.